Bonjour tout le monde. Hello, I'm Rebecca Spence with the press office at the Bank of Canada. I will be moderating today's press conference on the interest rate announcement. Le gouverneur Tiff Macklem va commencer avec sa déclaration préliminaire. Ensuite, on va tourner aux questions des journalistes. After Governor Macklem's opening remarks, he and Senior Deputy Governor Carolyn Rogers will be pleased to take questions until about 11:15. So, over to you, Governor.
Well, good morning and thank you. I'm very pleased to be here with the Senior Deputy Governor Carolyn Rogers to discuss today's monetary policy decision. Since our last decision in July, the conflict in the Middle East has persisted without a clear path to resolution. Closer to home, the United States has imposed new tariffs on Canadian exports, and the Canadian government has responded with proportionate tariffs or counter tariffs and new supports for hard-hit businesses and workers. Against this background, the Governing Council assess the economic data since our last decision, the evolving risks to the outlook, and the implications for monetary policy. With recent data coming out largely in line with our July forecast, we decided to maintain the policy interest rate at 2.25%. We have three main messages today. First, economic growth in Canada has picked up after stalling over the past year. That puts us on a stronger footing as the Canadian economy faces new challenges. But uncertainty about the sustainability of the rebound has increased with new U.S. trade actions. Second, the ongoing conflict in the Middle East is keeping energy prices higher for longer, and this has increased the upside risks to our inflation outlook. And third, the Bank of Canada is committed to keeping inflation close to 2% over time. We will be a source of stability as Canadians navigate shifting global developments. Nous avons trois messages clés. Premièrement, la croissance économique au Canada s'est redressée après avoir stagné dans les dernières années. Ça nous place dans une meilleure position pour affronter les nouveaux défis. Mais la durabilité du rebond est plus incertaine en raison des nouvelles mesures américaines. Deuxièmement, à cause du conflit qui se poursuit au Moyen-Orient, les prix de l'énergie restent élevés pendant plus longtemps. Ça fait augmenter les risques à la hausse entourant les perspectives d'inflation. Et troisièmement, la Banque du Canada est déterminée à garder l'inflation près de la cible de 2% au fil du temps. Nous serons une source de stabilité pour les Canadiennes et Canadiens en cette période de bouleversements mondiaux. So let me expand on these 3 points. As expected, the economy strengthened in the second quarter with GDP growth up 3.3%, following very weak growth in the first quarter. Some of the strength was due to temporary factors, but the pickup in activity was broad-based. Consumer spending remained resilient, and following several weak quarters, there was some rebound in housing activity. Exports and business investment were up sharply, and the labor market has also improved in recent months, with increased hiring by the private sector and the unemployment rate edging down to 6.4% in July. Still, recent indicators point to continued excess supply in the economy. The increases in exports, investment, and hiring are broadly consistent with what businesses have been telling us. They are adapting to tariffs, to uncertainty, and to new technology. Overall, the data reaffirm our view of a broadening recovery. However, new U.S. tariffs and increased trade uncertainty pose risks to the sustainability of the rebound in economic activity. If tariffs remain in place, they will hit targeted sectors hard. But we don't expect them to have a large direct impact on the overall level of economic activity in Canada. Affected products represent about 5% of exports to the United States, and the federal government's support programs will likely mitigate some of the harm. However, the situation does remain fluid. The added uncertainty about the future of Canada-U.S. trade relations may lead businesses more broadly to delay investment and hiring decisions. CPI inflation has remained around 3% in recent months, mainly because of persistently high gasoline prices. This is a direct result of the conflict in Iran, which has kept global oil prices high and has led to elevated margins for refined products like gasoline and diesel. Excluding gasoline, inflation in Canada was 2.2% in July, and measures of core inflation have remained close to 2%. Market expectations for oil prices have shifted up since July. The bank has been looking through the direct impact of higher oil prices on inflation, but we're monitoring closely for any signs that they are spreading to the prices of other goods and services. We haven't seen much evidence of that yet. But with the conflict ongoing and shipments through the Strait of Hormuz still curtailed, upside risks to our inflation forecast have increased. The longer oil prices and refinery margins stay high, the greater the risk that higher energy prices spill over and turn into persistent inflation. In addition, the new U.S. and Canadian counter tariffs could add costs to some businesses and feed through to consumer prices over time. La politique monétaire ne peut pas renverser les effets des droits de douane ni influencer les prix mondiaux de l'énergie. Ce que nous pouvons faire, c'est nous assurer que les événements mondiaux ne mettent pas en péril la stabilité des prix au Canada. Depuis notre dernière décision, l'inflation et la croissance au Canada ont évolué largement comme prévu. Dans ce contexte, nous avons décidé de laisser le taux directeur inchangé. Cependant, les risques à la hausse entourant l'inflation ont augmenté et les nouveaux droits de douane rendent les perspectives de croissance plus incertaines. Le Conseil de direction va évaluer la durabilité du rebond économique et les perspectives d'inflation. On se tient prêt à ajuster la politique monétaire selon les besoins. La Banque reste déterminée à préserver la confiance des Canadiennes et Canadiens dans la stabilité des prix pendant cette période de bouleversements mondiaux. Monetary policy cannot offset the effects of tariffs or influence global energy prices. What we can do is ensure global developments don't jeopardize price stability in Canada. Since our last decision, inflation and growth in Canada have evolved broadly as forecast. Against that background, we decided to leave the policy rate unchanged. However, the upside risks to inflation have increased, while new tariffs make growth prospects more uncertain. Governing Council will assess the sustainability of the economic rebound and the outlook for inflation, and is prepared to adjust monetary policy as needed. The bank remains committed to maintaining Canadians' confidence in price stability through this period of global upheaval. And with that, the two of us would be pleased to take your questions.
Merci. Thank you, Governor. We will go to questions now. We have a large number of reporters joining us today on the call, so we kindly ask that you limit yourself to one question so that we can get to every media outlet. Before asking your question, kindly state your name and affiliation, and please mute your line if you're not asking a question. Libre à vous de poser votre question dans la langue officielle de votre choix. So in the first group, we'll start with Paul Vieira of the Wall Street Journal, followed by Craig Lord of Canadian Press, and then Paula Tran of the Financial Post. So go ahead, Paul.
Can you hear me, Governor? Is your opening statement, does it reflect the fact that you're now more concerned with inflation than any drag on growth that the trade conflict presents?
Well, Paul, we highlighted both risks. We're concerned about both risks. The Canadian economy, we saw a pretty strong rebound in the Canadian economy in the spring. It's come into the summer with more momentum. That's certainly encouraging, but there is still slack in the economy, and new American trade actions have increased uncertainty about how sustainable that rebound is. On the inflation side, look, inflation's running 3%. That's too high. Our commitment over time is to deliver 2% inflation. When you look at that inflation, it is very concentrated in in gasoline, in oil prices, which are a direct effect of the conflict in Iran. I mean, CPI ex gasoline is 2.2%, but the conflict in the Middle East is it's ongoing, it's dragging on. There's no clear resolution in sight. And the longer it goes on, the longer oil prices remain high, the longer refinery capacity is taken offline and margins are high, the greater is the risk that higher energy prices start to spill into the prices of other goods and services. And then you get more generalized inflation, which could become more persistent. So, look, today we held our policy rate at 2.25%. The data we've received since our last decision was broadly in line with our forecasts. But as I've just outlined, the risks are shifting, and we are prepared to adjust monetary policy as needed. Coming down to, we are worried about both risks. The most important thing that is going to guide our decisions going forward is going to be our inflation forecasts and our assessment of the risks around that. Our inflation forecast, it includes the effects of slack in the economy, the downward pressure that puts on inflation. It also includes the effect of higher oil prices on the trajectory for inflation and the potential for that to spill over. What we're really going to be, we're going to be updating that forecast. We'll have a new forecast at our next meeting. And that will really guide our decisions. Our beacon, as I said, is our 2% inflation target. We are committed to getting inflation back to 2% over time.
Go ahead, Craig.
Good morning, governors. Thank you for taking our questions. Craig Lord with the Canadian Press. Counter tariffs from Canada against the United States will go into effect on September 8th. How do you judge the inflationary risks tied to those right now, given that the economy is also expected to struggle to grow under the weight of a re-escalating trade war?
Yes, the counter tariffs and indeed the U.S. tariffs also will add costs for some businesses. There's no question about that. And, those costs have to go somewhere. So over time, they could feed through to consumer prices. With respect to the counter tariffs themselves, they're mostly on intermediate inputs. Not much of them is on, not much of them is going to directly impact things that are in the CPI. So, what that means is, the effect is less direct. It's going to take more time to pass through. So, we will be refining our estimates. We'll have, when we update our forecast, we'll have to put a number on it. But, our assessment at this point is that the inflationary impact of those counter tariffs is fairly modest. The bigger issue for inflation is really what's going on in the Middle East. I mean, oil prices, we saw while there was that ceasefire, you saw oil prices come down. Obviously, the ceasefire is over. The conflict has re-escalated. Oil prices are back up. In our July forecast, we had oil prices in Q3 at $75. I mean, they're sitting at about $90 today. The real issue is how long do those oil prices stay high? How high do they go? And as I said, the longer that drags on, the bigger the risk that it starts to spill over to the prices of other goods and services. So yes, we are going to be tracking the effects of the counter tariffs, but the much bigger impact is really what's going on in energy markets.
We'll go next to Paula.
Hi there. Thank you for taking my question. Governor, you previously said further rate cuts may be needed to support economic growth if the U.S. poses significant new trade restrictions. Given what has happened recently, do you see that happening in the near future if trade tensions drag on or intensify?
Well, when this trade conflict started with the United States, when the U.S. first we were not looking for a trade conflict, just to be clear. But when the U.S. first imposed new tariffs on Canada, we did lower our policy rate, and we have held it low. We have held it at that lower level to try to support the economy. Look, there are two things going on. Yes, the tariffs have weighed on growth. what we saw in the second quarter is we saw the economy rebound. And what businesses are telling us, more than a year into these tariffs is, they are adapting to higher tariffs. They're finding ways to work and manage uncertainty with their U.S. clients. They're diversifying their exports. They're shifting their supply chains, and you can see that in the data. The economy is on a lower track, but exports have rebounded. Investment has come up. Hiring has been stronger in recent months. So the economy has been working through this. Yes, there is a new challenge. There's been a breakdown in trade discussions with the United States, and that certainly makes that rebound more uncertain. But as I stressed, we have to keep our eye on inflation. Inflation is running too high. The situation in the Middle East is no closer to resolution, and the longer it goes, the bigger is the chance that feeds through. As I said, where we go on interest rates is really going to be guided by our inflation forecasts and our risks around that. So yes, the risks posed by new trade actions that could, that endangers the durability of this rebound. There's already slack in the economy. If slack remains, if there's more slack, that'll put more downward pressure on inflation. But there are also important upward pressures on inflation, and we've got to look at all that together.
Next on my list, I have Mark Rendell from the Globe and Mail, followed by Pramit Mukherjee from Reuters, and then Najoud Al-Maliz from Bloomberg. So go ahead, Mark.
Hi, Governor. Mark Rendell with Globe and Mail. I'm wondering if you can kind of talk us through how you're thinking about the economic shock, downside economic shock of this breakdown in trade negotiations. As you say, it only hits about, the new U.S. tariffs only hit about 5% of Canadian exports, but obviously there's going to be business confidence knock-on effects, other things like that, and the threats of significant retaliation from the U.S. as well. So how are you thinking about how this plays out for the Canadian economy, and are we talking about heading back to some of the downside scenarios for the trade war that you had outlined last year?
Well, I think you partly answered your own question, but let me highlight a few things. First of all, we're coming into this with the Canadian economy on a better footing. As I just went through, businesses have been adapting to an environment with more uncertainty, higher tariffs, and it's not easy. It's difficult, but they've got businesses to run. They're getting on. They're finding ways to do business. That has put the Canadian economy on a better footing going into this latest new wave of U.S. tariffs. The second thing I would highlight is, as you mentioned, these tariffs are very steep, but they're applied to a relatively narrow base. So the businesses that get hit by these are going to be hit hard. There's no question about that. But certainly we expect to see some impact if those tariffs remain in place. You will see some impact on growth, particularly in the fourth quarter. But when you look at their impact on the economy overall, they're hitting about 5% of our exports to the United States. So we don't expect a big ongoing impact on overall economic activity. I would highlight direct impact. As you mentioned, look, uncertainty has gone up. This environment could cause more other businesses to hold back on business and investment decisions. And then there are threats of further actions. There could be further escalation. There are also other outcomes. Canada and U.S. were close to a deal. Certainly, look, Canada's not applying counter tariffs because they want counter tariffs. Canada's applying counter tariffs so we can get back to lower tariffs, and those can get rolled back. So, there is a range of outcomes. We're going to have to assess their impact on the sustainability of this recovery.
Pramit?
Hi, Governor. This is Pramit Mukherjee from Reuters. Uh, since July, the risks have clearly changed. I mean, tariffs have escalated, Canada has announced retaliation, and energy prices have remained high. Yet the appropriate policy rate appears unchanged. Has the balance of risk genuinely remained the same? Or do you think that inflation concerns are becoming more pronounced?
Um, I think I've answered that question, Probit. So I'm going to ask the senior deputy governor to give her perspective.
Okay, so I'm going to try and come up with something new. I mean, monetary policy is never about one risk or one piece of data. We're always weighing multiple pieces of data. We're always weighing the balance of risks, and that's that's definitely the case right now. As you said, Pramit, things have changed since July. We're looking at risks to growth that come out of the trade conflict we have right now. And then we're looking at risks to inflation that come primarily out of the situation in the Middle East. Both of those things have escalated in recent weeks coming into this decision. We're going to watch both. We've talked in the past about two layers of uncertainty. There's the uncertainty about the situation themselves, how they evolve. They're both pretty dynamic right now. And then there is the uncertainty about how they're going to transmit through the economy and their effects on growth and inflation. So we're watching the data. Yes, both have changed. As the governor said, ultimately, our mandate is to preserve price stability for Canadians, and that's what we're going to be focused on.
Najib?
Hi, Governor. You've warned about the risks from a rapid unwinding of overinvestment in the US. So I'm going to double barrel question here. Does the recent global bond rout look like a healthy repricing of risk? Or are you seeing signs of market dysfunction that could become a systemic problem? And to add on to that, do you think the US Treasury's interventions in the bond market have been appropriate?
Okay, you have packed a lot into that question. Maybe we will share the response. I'll maybe say a few words about more from a monetary policy perspective, and I'll ask Carolyn to say a few words more from a financial stability perspective. I mean, yes, we have seen global, particularly U.S. Bond rates move higher in recent weeks. So what's going on there? Well, when you see a substantial movement, usually it's because there's more than one thing happening at once, and they're reinforcing. Look, underneath it all, we've got high levels of sovereign debt globally among some of the biggest countries, with continued strong issuance. That debt needs to be absorbed. That's kind of underpinning this rise in global yields. But it's not the only factor. You've got a big build out of AI infrastructure that is putting a lot of corporate demand for bonds or for issuing more bonds. That has to be absorbed. That will tend to affect bond prices. And you've also, as we've discussed, look, the situation in the Middle East hasn't got any better. Oil prices remain high. There's no resolution in sight. That is, central banks' tolerance for higher inflation is limited, and that is causing the market to build in the possibility of future interest rate hikes. So all those things are tending to work in the same direction to boost global bond yields. In Canada, our yield curve is actually well below the U.S. yield curve, and depending where you are, it's percentage point or more below. And that reflects a few things. Our fiscal situation is better, inflation is lower, the economy is weaker, and the flexible exchange rate combined with our inflation targeting framework gives monetary policy the ability to adjust monetary policy for the needs of the Canadian economy. Our yield curve is well below. We are seeing some spillover of global bond yields into Canada. And that is something we will take into account in our monetary policy setting. We always look at financial conditions. There's almost always a few sentences in the press release assessing how we think they've changed. We noted that with the rise in global bond yields, financial conditions have tightened. And you have to look at more than bond yields. So you got to look at equity markets, you got to look at the exchange rate, you got to look at corporate spreads. So going forward, that is something we'll take all that into account. That'll be built into our forecast. Perhaps the more serious issues are around financial stability, and I'll ask the Senior Deputy Governor to say something there.
Yeah, I think it's important to distinguish between volatility and dysfunction or instability. When prices and yields are moving because investors are repricing risk, that's a functioning market. The vulnerability that we have talked about in our previous financial stability reports really comes when you get leverage investors unwinding their position quickly and liquidity starts to dry up, and in particular, when those markets are intertwined with the repo markets and they start to spill over into core funding markets. That's the risk we worry about. We don't see that happening right now. What we see happening right now is a repricing of risk. Of course, we'll keep an eye on it.
All right. Next on my list, I have Mackenzie Gray from Global News, followed by Anna Pereira of the Toronto Star, and Jeff Lagerkist from CBC News. So go ahead, Mackenzie.
Hi there. Governor, you've talked before about there being a permanent lower growth path due to these tariffs. I know you don't seem to be too concerned about the new tariffs that come into place. Can you outline how much lower the growth path has been over time because of these tariffs? And is there not an increased concern with these new tariffs because they apply to a wider variety of goods that could lead to contagion across a broader subsection of the Canadian economy?
So, with respect to the lower path, what I'm trying to explain and make sure everybody understands is that we've seen growth rebound in the second quarter. That is evidence that businesses, workers, they're adjusting. Canadians are adjusting to this higher tariff, more uncertain environment. But we could, if we could magically roll back tariffs, get rid of the uncertainty, we could get back to a higher growth path. Obviously, those things are not directly within our control. What is in our control in Canada is the investments we make as a country, the structural reforms. If we obviously we need to do our best to work with our global partners to get to a better place. We have an important seat at the global table. We are talking to the Americans. We need to use those discussions, but we also need to do things here in Canada to better integrate our domestic market, diversify our exports, improve our productivity, enhance our investability. Those are things we can do with our country. Those will get us back to a better growth path. Monetary policy can't do that. That's not something that's within our control. We really have to sort of take that path for potential growth as given. We do our best to estimate it, but the higher that path is, the more the economy can grow without building inflationary pressures.
Go ahead, Anna.
Hi, good morning. Governor, I'm wondering, why did you drop a line from the opening remarks that said that the current policy rate is at the right level to keep inflation close to target while supporting the economy?
Yes, sometimes you over-rotate on these changes. Look, we held. I think the message today is we had that line last time, and we had a forecast last time. Since our July meeting, the data we have has come out broadly in line with that forecast. You'll remember at our July meeting, we could see that there was clear evidence that the economic activity was picking up. Obviously, inflation was around 3%. Inflation's still around 3%, and that evidence that we saw of the economy picking up has indeed been realized. We saw a strong rebound in the second quarter. Economies come into the summer with more momentum. The risks, though, around the forecast going forward are shifting. The upside risks to inflation have increased. The durability of that rebound we've seen in economic activity is more uncertain with new U.S. trade actions. We don't have a new forecast this time. We will at our next meeting, and as I said, we will be. Ultimately, we're going to be, our interest rate decisions are going to be guided by our outlook for inflation and the risks around that. We'll have to come to a judgment about where interest rates need to be to bring inflation back to target. That will be, front and center when we get to our next decision.
Go ahead, Jeff.
Thank you, Governor Macklem. My colleagues have actually already touched on the question I was going to ask you, so I will pass on to the next.
All right. The last group on my list, I have Greg Quinn from Market News, followed by Robert McLister from Mortgage Logic News, and then Max Sato from Mace News. So go ahead, Greg.
Good morning. Are you still in a situation where if inflation becomes a problem, that consecutive rate increases could be required?
Greg, look, there are a number of scenarios and a range of possible outcomes. Best outcome would be resolution in the Middle East, Strait of Hormuz opens, oil prices come down, new trade agreement with the United States, tariffs are rolled back. We could get lower inflation and stronger growth. But yeah, that's not the only outcome, obviously. Both those things could become more complicated. And with respect to your question, certainly if we felt that inflation was going to remain too high, yes, we are prepared to raise interest rates, and if it takes takes more than one increase, we're prepared to do that. But that's certainly not the only outcome. I mean, our judgment today was to keep the policy rate where it is. We've highlighted the risks on both sides. We've been clear that our objective is to get inflation back to 2%. That's our beacon.
Go ahead, Robert.
Good morning. Canadians are making mortgage term choices today that could significantly impact their family budgets. I'm wondering if you could help folks understand why swap and forward markets might be pricing in high, implied probabilities of 3 rate hikes in the next 12 months, and how much will you factor in market expectations in your future policy decisions?
I mean, in terms of explaining what the swap markets are pricing in, I mean, I think you have as good an eye on that, Rob, as we do. I mean, there's we talked about what yields are doing. They're pricing in a number of things, debt levels, expectations for policy rates based on inflation expectations. So there's a lot going in. We take these factors into account in every rate decision. We talk about market conditions. We talk about yields. We talk about equity markets, exchange rates, commodity prices. All of those things feed into our rate decision.
Go ahead, Max.
Hi, good morning, all. My question is, you might have already answered it, but long-term interest rates are rising globally over inflationary and fiscal policy concerns, which have actually lifted borrowing costs in some economies. And that seems to be already doing a financial tightening job, and some central banks have been raising rates or about to raise. Meanwhile, the U.S. Treasury Department is concerned about the strong dollar and weak yen. And so how is this all going to affect your policy decisions in coming months?
Well, I think I have largely answered that question, but let me just take it a little bit further. So, as we've both discussed, there are a number of factors that have pushed long rates higher, and that, along with everything else that determines overall financial conditions, is something we will take into account as we chart our future decisions. But it is important to remember, though, that to the extent that higher interest rates at the curve reflect expectations about what monetary policy needs to do to achieve its objective. I mean, monetary policy, if that's what we think we need to do to achieve our objective, well, we'll need to do that. We're prepared to do that. If monetary policy doesn't do what it needs to do to achieve its objectives, then markets will reprice. I think the fact that markets sort of understand our reaction function and know that when oil prices are higher, they've been higher for longer, the upside risk to inflation have increased, they, I think quite correctly, infer that, that's getting our attention. And that has some effect on bond markets. But that doesn't mean we don't need to do something if ultimately those risks materialize and inflation is too high and we think it's going to stay too high.
I believe we have one last question from the Logic. David, are you online?
I am. Thanks very much. We've been talking a lot this morning about the effect of U.S. tariffs on Canada and Canadian counter tariffs. How are you thinking about the long-term effects on the Canadian economy of what the United States economic policy is doing to itself as our biggest customer? Usually they have a recession, we get a recession. What does the future look like, even if things go back to normal between the two countries?
Well, I certainly hope we can get back to something that is more normal. And as I mentioned, we didn't want this trade war. We have a Canada, U.S., Mexico trade agreement. Canada signed it. This U.S. administration signed it. These tariffs contravene that agreement. Canada has imposed counter tariffs in response to the latest tariffs, not because we want to put tariffs on our exports, because we want to get back to a better place. We want those tariffs to be rolled back. But look, I think we have to be realistic. I don't think we're going to get back to where we were. Certainly, this U.S. administration, they like tariffs. They like protectionism. I certainly hope we can get back to a better place. Lower tariffs are good for both countries. If rationality prevails, that should happen. Governments should be doing what's good for their citizens. But yeah, there is some uncertainty about how that plays out. But I think, if you're running a business, if you're a worker, it would be nice if we could go back to where we were. But I don't think we can count on that. And certainly what we've seen, talking to businesses over the last year, they've kind of worked through the stages. You start with sort of shock and surprise that your closest partners are attacking you. You're kind of in denial. You're angry, but you get to coping, and you get to adapting, and you get to moving on with your business, and that's what we've seen. And I think that is reflected in the data that we have. You are seeing the Canadian economy. You're seeing businesses are adapting to this. It could be much better than it is, but the Canadian economy is coping. It is adapting. It is responding. Governments have a role in this. The private sector has a role, but you're seeing the economy rebound. Yes, this new round of tariffs are a new setback, but I have no doubt that Canadian businesses will find ways to do business.
All right, that concludes today's press conference. Thank you, Governor, Senior Deputy Governor, and all of you for joining us. Merci.
Thank you very much.
Thank you.